In this video, we're going to move on to our final step in the presentation of our income statement. And that's going to take us from the point we left off, which was income from continuing operations before the extraordinary item. Now, the inclusion of these two phrases, continuing operations and extraordinary items, tells the user there are some events that occurred this year that are probably not possessing good predictive value. And that is discontinued operations and an extraordinary item. We will be presenting these net of tax because the income tax effect, the income tax expense, has been accounted for already and matched to the current year's revenue. And it's calculated based on income before taxes and extraordinary items from continuing operations. So we break this out because we want to give the user a number that has good predictive value, and neither discontinued operations nor an extraordinary item provides that. So income tax has been figured, so anything we present after this has to have the tax effect calculated in. In textbooks and in accounting standards, this is called intra-period tax allocation. And the allocation is tax that relates to continuing operations and tax that relates to discontinued operations and extraordinary items. This is our final section that we'll be looking at. Let's start by looking at discontinued operations. When we talk about discontinued operations, it's important to note several things. First, they can have been discontinued by the end of the period, or we could be intending either to sell a segment of the business or shut it down and abandon it completely. Based on either the actual event occurring or our intention, we will break out all revenue and expenses from the segment that we are going to discontinue. So none of that is going to be presented in the operating income section of the income statement, and that's why we call it continuing operations. We take out all of the revenue and expenses, and we combine revenue minus expenses plus or minus any gains or losses from the sale of the segment or the impairment if we are going to abandon the property. So we could either sell a segment whole, a division, to another company, or we can sell off its operating assets, or we can abandon them. And again, this is presented net of tax. So the income tax effect is figured in. And we'll use an example in just a bit. The next item we're going to look at is our extraordinary item, and the GAAP definition of an extraordinary item has to contain both of these qualities. It has to be unusual in nature, outside of the normal business risks, and it has to be infrequent in occurrence. Now, this often can lead to some questions. In this case, we have an earthquake. If this company was located along the San Andreas Fault, well, an argument could be made that, well, that happens quite a bit, so it is not unusual in nature, nor is it infrequent in the absolute term. But in the normal business risk scenario, we would not place operating assets right on top of a fault line that we knew was going to present problems. So uh, the gap interpretation of this has always been things that fall outside of the normal business risk. Now, if an event is, say, unusual but not infrequent, that is, in the normal course of our operation, this is something that we were to see, well, then that cannot be classified as an extraordinary item. Instead, it's going to be presented as one of those other items we saw in the presentation of operating income. So, for example, something like restructuring costs. Restructuring costs are unusual, but well within the normal business risk. Even if they're not, does not occur frequently, this is not an unusual event. So we do not classify these as an extraordinary item. Finally, let's take a look at what is meant when we use the term net of tax. In our example, the loss from the earthquake is presented at $60,000. Let's see how we arrived at that. The actual earthquake damage that was not reimbursed by insurance presented a loss of $100,000. This company has a tax rate of 40%. The loss can be deducted in calculating income tax. The measurement of the loss is the $100,000 in damage times the tax rate, or 40,000. When we have a loss and that leads to a deduction, this is called a tax benefit, in that it will reduce the overall tax expense, if not in this period, in either a prior period or future period. And this is something we'll discuss in Intermediate 3, or in the current period. So, when we say something is presented net of tax, it is either going to be in addition to, if it's a gain, or in this case, when it's a loss, it will be called net of tax benefit, and that represents the deduction for the loss. In this case, it's our loss minus our deduction, or a benefit of 60,000. That's presented as a negative amount because it is going to reduce down net income from our income before extraordinary item to our net income. So we finally get down to our net bottom line. Because of the many complications that you can occur, it is always wise to look beyond net income when you're conducting a financial analysis.